Initial public offerings or IPOs, for many investors think that's great. I can get in the ground floor of a company as it goes public and I can make a ton of money. And we'll find as we go through this, it might be harder to do that and actually to even make money. We got an example at the end of this lesson too, so stick around for that. I think you'll find it quite interesting. So first let's talk about, well, what is an initial public offering or IPO? Well, it's when a private company goes public, right? And by going public, that means it's listed on some type of stock exchange. It could be anywhere in the world, an established exchange like the Nikkei or the NASDAQ or the New York Stock Exchange or whatever. There's lots of stock exchanges. But private companies are not listed on those exchanges. Private companies are held by a smaller group or owners or maybe one person or partners, smaller group of insider, well, I don't say insider, but inside people who own the company, right? It's private. It's not publicly traded. I can't buy and sell stock in a private company. But a public company, I can buy and sell stock. And that's why companies go public, so they can buy and sell stock and be listed on the stock exchange to raise money and some other things to do around that. And we'll learn about that also in a second too. But first off, the understanding initial public offering or IPO, a private company is going public. It's going to be listed for the first time on a public exchange. And traditionally, it was only solid companies that went public, right? It was like, oh, we've been a private company, we've really grown, we're doing terrific. Now we can go public because we're well established and people will really value and buy our stock because we're an established private company. Traditionally, that's how it was, right? But then investing or trading is all about the future. So it's all about the future prospects of companies. I want to buy at a certain price with the hope that the future will be good for this company and I'll have some capital appreciation, maybe even some dividends along the way. But I'm looking towards that future growth. And that's what investing or trading is all about, is what does that future look like? And what is the first kind of mover advantage of some companies that might be larger or starting to go public within an industry? And it was always usually very, it's always speculative, but it was always kind of around these solid companies went private. And then the internet boom kind of happened. Well, more than kind of happened, I guess. And all of a sudden you had lots of companies going public that really had no establishment of facts or anything to really a leg to stand on as far as the quality of the company. Most of those companies actually were never a turn to profit. They were just kind of like, we've been borrowing money or getting venture capital in here, people investing in the company in a private manner. And then we would go public, and then we'd raise more money basically from the shareholders. I'm buying stock, and that initial stock sale goes into the company. And the idea when companies go public is they want to take the money that they have coming in from that initial sale before it's traded back and forth between folks like you and I. But that initial sale of stock, that's a big infusion of cash that goes in the company. And they use that, the idea is they use that to grow their organization. That's what you're looking for. So companies are going to take that money, invest in their company, and grow their organization. Maybe it's a retailer that says, we've been doing great in this area of the country, but now we want to expand to the rest of the country. We want to expand worldwide, and we need money to make that happen. So we're going to go public. You might have heard the term going public. So we're going to take our private company and go public. So that's one big thing as far as an infusion of cash to invest and grow the organization. That's what we're really looking for. Now, there's also an element of the founders or the owners, the creators of the company, have now want to cash in. They want to have their own exit strategy, right? They've put all this blood, sweat, and tears in the company. They've grown it to something. Now they've gone public, and this is where they can really cash in and really receive a lot of money, not only to the company, but money that they can then take for themselves, that they can use to basically to pay themselves. And for many, it's an exit strategy where they grow the company, and their whole idea is not to maybe even continue to run the company. They just want to get the infusion of cash, take their part, and then leave the company and turn it over to others to manage. So think of IPO as the initial offering of a company for the initial offering of stock, and you're trading on the future, and hopefully you're looking for companies that will grow and they're investing to grow, but there'll be some element of exit strategy or cashing out. Now there's a lot of internet, especially technology companies that might be smaller, and their whole goal of creating the company was to have an initial public offering and then raise a lot of cash for the founders, and then they cash out big time, and it's really not a sustainable company. Or it might grow to a point where maybe a larger company will buy them, they'll merge or acquire the company, and that's how they get their money too. So there might not really be much interest in growing the company long term, just a short-term gain. So you might want to watch out for those. And I was mentioning the internet boom. It was a real interesting thing because that's where it really turned in a great way during the early 2000s or in the 90s. That is, during the internet boom, where you saw these great valuations of companies, you saw stock prices really kind of booming. And you had companies like these internet companies, Pets.com is a famous one for that, and there's others out there too, where they really had never ever turned a profit. Their business model might be a little suspect. They couldn't even necessarily articulate it well. And what is the long-term prospects? But the money was growing so fast. We were really in a bubble, the internet bubble, the technology bubble, that you could almost launch any kind of company. And if it was technology, internet-based, people are thinking, oh, this is the dawn of the internet. This is the birth of the internet. I want to get in and invest in these companies that are really speculative and hopefully ride that wave. Well, many rode that wave up, but then they rode that wave crashing on down too, because a lot of these companies had no real business plan, no real fundamentals. And so we survived that period. Well, of course, you survived that period, but think about that, especially when trading or the market's really rising, when you're looking at maybe these younger companies, what are their, what are their growth prospects? So how does it kind of work? So how does initial public offering or IPO work? Well, first off, you have an investment bank that manages it, right? There's called underwriters, and they kind of put it all together. They help, determine like the initial price that this initial public offering will be based on their experience, based on the market, based on a lot of factors. And companies pay big dollars to these big institutions to help them go public. And so they really rely on that. And then when it hits the market and it becomes public, we can buy. Now, the challenge is a lot of the insiders and folks that are tied to these big investment banks, they get kind of a first shot, an early shot before it really truly goes public. So we're not necessarily buying at that initial price. You've got owners or founders in the company. You might have employees of the company that own stock in that company, private stock, and you have institutional investors and big investors who might have a crack at getting that before it goes public. And there's some scandals around that too. And we'll talk about like Facebook. There's all sorts of scandals around, insiders getting in first before it really went to the general public, and some things that happened after that. Now, so since we're getting a little bit later, you can still buy a stock at its initial public offering price, and maybe it'll go up or maybe it'll go crashing down. The investors, the institutional underwriters or investment banks try to get an accurate price, but once it gets out there, it's a free market at that point, and so the price could go up or down. In fact, history shows initial public offerings, the prices will tend to go down, at least for a period of time. So if you're thinking, I'm going to buy an IPO because it's going to go up right away and then I'll cash in, be cautious of that. It's a very, very risky strategy to do. So especially early on, the price can be very volatile, going up and down as the price kind of settles. There's also what's called a lockup period, and that's very important to understand. It's typically 90 days. And what that means is that 90 days, that's when the insiders can sell. So if I'm Steve Jobs and I founded Apple with Wozniak and we went public, well, there's rules around that where I can't sell my actual stock, my private shares that are now turned into public shares and worth millions and maybe billions of dollars. I can't sell those until a 90-day waiting period or a 90-day mark, as far as that waiting period for those insiders to sell their stock. So they have to wait 90 days. So what does that mean for you or I as far as that 90-day mark? Well, think about it. The thing goes initially public offering, we can buy and sell, and then the days start counting down, and then when 90 days hit, what can happen is a lot of those insiders are now looking to capture what money they've got. They want to take their winnings. They want to take their earnings. Maybe they're a venture capitalist that put a lot of money into the private company. Now they want to get their big payout out. So what happens at 90 days is the stock price can really take a hit from an IPO. Potentially can take a hit because all those folks are exiting the market, and you have more sellers than buyers, and it causes the price to drop. So be aware of that 90-day mark. That might be a time, if you have a stock, to sell it before that. If you bought it on the open exchange, you're not an insider then. Or buying it after that 90-day mark too, and then you might have the price settling down a little bit, less volatility, and you'll have all those inside investors getting out, between that 90 to 100-day mark, and now you'll have a little bit more truer valuation of what might be happening with the stock. So that 90 days is real important. And really, the big thing I'd really caution folks is don't buy an initial public offering or something that's initially listed for its first day in the market just because it's an IPO. So many people get caught up in the behavioral economics of it or the emotion of it, like, oh, this great private company went public, I'm going to buy it now on its first day of publicly trading as IPO. You might be excited about the company, but I would urge caution on that. Do your due diligence, do your research. Maybe you feel still real comfortable about it, but I know history shows it can be a risky thing. So just keep that in mind if you're looking at something that's just gone public as initial public offering. That doesn't mean it might not go public and go up from there forever. I'm not making a recommendation one way or another. I am saying that history shows initial public offerings right when they go public are very volatile and can be real problematic. And certainly if you're a risk-averse investor, these are much more risky things when you're getting early into initial public offering. Let's take a moment to look at one case study or one example I think you might find interesting around initial public offerings, and that's with Facebook. So let's look at this initial public offering of Facebook as a case study and kind of show you how the volatility of these IPOs can be, and sometimes there's challenges and things around that. And a little background on Facebook. I mean, think about an exciting public offering. So many people were using Facebook. They were dominant in their market space of social media. Places like MySpace, remember MySpace, were gone or on their death throw. So Facebook is like, my gosh, they're the next Google or their next whatever. This is great if we can get in there. And there's a lot of excitement around the initial public offering of Facebook when it went from a private company to a public company. And a lot of people are excited to buy that. Now, a couple of little background things. There's some shenanigans as far as the pricing of the stock and who was getting insider stuff, who could buy it before the actual public offering or have this insider stuff and have some shares that they own. So you can read up on that, but there was a lot of stuff on lawsuits around that. I think Facebook actually was exonerated on a lot of those things too, but it was really kind of weird before the public offering. But let's look at it as an example of an initial public offering that could be good at some points or bad at some points, depending on your point of view. So let's start by looking at this chart, and we're going to look and see how the price changed over a period of time, basically over about a year and a half, almost 2 years, over a 2-year period, almost 2-year period. What happened since it was initial public offering of Facebook, and how did the price kind of move? Let's take a look at the chart and see how it went. Okay, so if we're looking at the chart here, you'll see on the, let's just analyze the chart for a second and set it up. On the far left where it says trading days after IPO, or how many actual total days had occurred after the initial public offering from its first day of being available to the public out to 640 days later. So you can see where it went public on May 18th in 2012, and this chart's looking at to February 19th, 2014. So that period of time, obviously we were well beyond 2014, so there's been lots of changes since then. But we want to look at that initial couple-year period to get a feel for what can happen with an IPO in its early days. All right, so the share price, or at the market close, or what the offering price was going to be determined was $38, right? So the investment bankers and Facebook all got together and said, yeah, this stock is worth $38. And behind the scenes, people were saying that was way too high, but there's a lot of excitement, there's a lot of motion, so they're saying, okay, let's go for $38. And so its first day, May 18th, you can see where it says first day there on the left, it closed at $38.23, right? So it's right there, right at the close of the market or the end of the first day, they're at $38.23. If we go over to the second from the right column where it says 0.6 there, that means it was up slightly, right? They initially offered at $38 and it went up a little bit from the beginning of the day at 38 to 38.23. So up just a little bit, up 0.6. So the next thing is the first day of trading after the IPO. Now you'll notice how the date is like May 21st. That's because the weekend was in there and there was no trading days on the weekend. So that left-hand column is how many actual trading days, available trading days, is occurring after its initial public offering or after its first close. So after the $38 on this, in effect, the first or the full second day or the first full day of trading, not full day, but the first day of trading, it dropped. Oh my gosh, it went from $38.23 to $34, a little over $34. So it dropped 11% in a day and down 10% from its original offering price. So you can see how the daily change and then the overall change is on the far right column, and we really want to pay attention to that. Because you can see on the next day after that, it dropped to 31. It was down another 8.9%, or overall from its initial offering price, it's down now 18%, right? So that's the initial $38 price. So boy, we bought this Facebook stock, but if you're excited and all of a sudden in 2 days, you're down like 18%, like yuck. And then you can kind of see how it goes from there, 6, 8, 9 days, and you can see it continue to drop each day, little blips of going up, but you're basically down 24, down 22, down 27 on day 9. You look at day 19, down 21%. Day 68, August 20th, it's down to $20, right? So there's some bad announcements and things with that. Actually, it was a good day for it on the day, because on day 19 it was up 6.1 for the day. But on August 20th, day 68 after the initial public offering, it went up 5% for the day. But really what we're looking at is that far right column. Yeah, it went up 5% for the day, but by day 68, it was down 47%. So if you had bought that stock at $38 or $38.23 on its first day, that you could maybe buy it, that was available, by day 68, less than 3 months later, it's now $20 and you're down 47%. And you're like, gosh, what a bad investment, right? Now, if you stick it out and hang on, you can see what's happening in day 578. It had quite a rise, and day 642, it's been continuing the rise too. So at day 575, you're well in the black. You're made 45%, and at the end of that almost 2 years, you're down 79%. Now, when it's the bleak days and you're within 3 months and you're down 47%, you lost almost half your investment at that point. Are you willing to stick it out and hang in there, and then maybe you'll rise to that 79%, which it did, or maybe it'll continue to go down? You're not really sure. So you got to look at what's happening there around with Facebook and some of the acquisitions and things they were making in 2013, 2014. So with that, you can see kind of how it can really go down. I mean, it could have gone up too, but you can see how it really changes here. One note about like day 68, and as you're getting closer to those days, towards that 90-day mark, that's a lot of people are getting out a little bit early too, because they know the 90-day mark is going to come, and there's going to be a little bit of selling pressure from those insiders. So they don't wait till day 89. They're smart to know, like, we better get out at day 45 or day 50. Especially maybe when the stock's really going down. Sure, some of those insiders might hang on to the stock hoping it'll go up, but a lot of them are just in it to get whatever money they can, especially venture capitalists. So at that point, they're like, we're just going to get what we can and invest somewhere else. So this chart's a good example as far as Facebook. I'm not saying Facebook's a good company or a bad company. I'm using this as an educational purpose to show, the volatility, especially early when we're only less than 2 years out of an initial public offering or initial public offering stock. The word to the wise on all of this is understanding what you're investing in, and think about, am I investing in this for a short-term gain? Am I investing in this because I'm trading or maybe speculating, maybe even gambling a little bit? Am I investing in this because I think there is or because it's an IPO and I'm just excited about an IPO? Oh my gosh, it's Facebook, it's an initial public offering, and I can get it for $38. Hooray! Maybe that was irrational exuberance around Facebook at that period of time. Or maybe you're a long-term investor that says, look, I know Facebook might go down in price or it might go up, but I'm here for the long term. I might own this stock for 5, 10 years, and I believe with the advantages they built in, I believe in Mark Zuckerberg and on the executive team, and I think Facebook's going to do great in the long term. Well, you were well rewarded in this particular example or case study. Now, every case is different, of course, so understand that. But the last comment or thought to leave with you around initial public offerings, for some stocks, people get very excited about initial public offerings because they might be a well-known, maybe beloved public company or a private company that's now gone public. Or maybe people have a little greed in there thinking, oh, I can buy it at this price and it'll go up, and isn't this a great thing? So just be aware of those emotions. And are you investing because it's the right thing for you and your family and your portfolio? Or are you investing kind of more emotionally based? And if you are, you might want to check that a little bit and just, grasp those fundamentals, look at your goals and your long-term strategy, and then see if maybe on the first several days of trading, if some of these initial public offerings, fit in your portfolio. But they're certainly more risky than just stocks that have been established for years and years. Another thing you might find out there is preferred stock. Well, it's not find out there. They have them out there. Pretty much all companies have preferred stock. And these are preferred stocks, and we're talking about it from a public company standpoint. There's different types of preferred stocks, but since we're talking about investing in stocks and we're talking about investing in public companies on exchanges, like New York Stock Exchange or NASDAQ or whatever, we're going to talk about preferred stock from that perspective. And really, a preferred stock is about the dividend, really. Their preferred stock is giving you kind of a dividend or a payout. And it's a fixed type of amount. It's not a variable amount. With dividends in a public company or normal dividends, they could change that dividend up or down. They could cut the dividend or do different things with the dividend. So there's a little more risk on there, and you would expect more return as far as growing dividends and growing stock price too. The idea is the stock price would grow faster, and certainly faster than a preferred stock. So you're looking at it from more of that fixed income aspect of that dividend and more of a fixed type of dividend. In terms of like if a company was to go bankrupt and liquidate and sell off everything to pay off its creditors or debtors or the people it owes money to, preferred stockholders are ahead of common stockholders, or what we think of as regular publicly traded stock is common stock. they would get paid ahead of the common stockholder. So if you own a preferred stock or preferred shares in the company and I bought it on an exchange or through my broker and I own common stock, well, if the company goes out of business, whatever little dollars is left, you get paid first before I get paid. Understanding usually gets paid first is one, the lawyers always get paid first. Congrats to lawyers and attorneys. So they get paid first, and the government. The government, if you own anything in the government, they're typically, depends on the country, I suppose, but typically the government's going to get their share first. So between the lawyers and the government, in a company that's going out of business, usually not a lot left. And then people own debt or bonds or things, they're going to get paid next, and then preferred, and then common stock. So even with preferred stock, company going out of business, you're probably not going to get much out of it. And don't invest in a company with the idea it's going to go out of business anyways, right? Preferred stock is a non-voting stock, so common stockholders, we get to vote and vote on shares. But once again, if you have one share and other people have hundreds of thousands of shares out there, well, your vote's not going to matter much for regular folks like you and me. But preferred stock is a non-voting stock. It's callable, like a callable bond. If you look into bonds and things, it's a company can buy back at any time. So if interest rates are rising, they could buy your cheap preferred stock back and then reissue it at a higher rate to people. So so in rising interest rates, kind of like bonds, where bond prices go down when rates rise, same with preferred stock, they could be callable, or the company could basically buy them back. And that's really how you want to leave the thing with preferred stock. Really think of it as more of a bond, more of a debt type thing. Think of it as a bond, and it acts like a bond, and it's more susceptible to things like interest rate risk, right? Interest rates rise, especially quickly, bond prices fall. Same thing with preferred stock. Preferred stock will fall and fall quicker than maybe possibly a common stock. At least historically or typically that is what it is. So if you like something there's a little bit more difference, then look at maybe preferred stock. It might not be as liquid as maybe a common stock as well too. So when we're talking about stocks in the course here, we're always talking about common stocks, publicly traded stocks. You can buy and sell them very easily. And the idea is you want to get a great growth on your capital appreciation and maybe pay a dividend for dividend paying stocks. Where preferred stocks, like, yeah, it's stock, it's a little different, basically a dividend or interest, and it acts really more like a bond. So if I'm looking at preferred stock, I'm thinking it's more similar to my bond portion of my portfolio than maybe my stock portion of my portfolio, even though it has stock in the name. You may have heard of stock splits. The stock splits are kind of cool things. So what is happening with a stock split, right? So first off, what it means is your stock is splitting or increasing. You're getting more shares of stock. So if I own 3 shares of stock and we have a 2-for-1 split, now I have 6 shares of stock. So that's a good thing, right? I get more shares of stock. For the existing stockholders. So that can be a good thing. Otherwise, you could also look at kind of diluting the whole mixture of stock out there. So that's a kind of a negative to it. But most folks look at a stock split as a good thing because they're getting more shares. Here's a better example for you on a 2-for-1 split. So sometimes you'll hear about a stock split where it's like, oh, it's a 2-for-1 split, or it might even be like a 3-for-1 or a 4-for-1. But the most common is like a 2-for-1, and the 3 and 4 acts the same way. It's just more splitting. So a 2-for-1 split, if let's say you own 100 shares of a stock, right? So you own 100 shares of this stock. And a 2-for-1 split would say, after the split, you now own 200 shares of that stock. You don't have to do anything with that. It's all of a sudden, wow, I own more stock. My statement will say I own more stock. And in the old days when they actually had stock certificates, paper things you could put on the wall or put in your safety deposit box, they would actually send you another stock certificate, so with these additional shares you own. You're like, well, great. I have 200 shares. I'm twice as rich, right? Is that terrific? No, it doesn't work that way. Because when a stock splits, not only do you get the double in the shares, but the share price goes down an equal amount. So let's say in this example, when it's 100 shares at $50 worth $5,000, let's say, we use US dollars for the sake of argument. It could be rupees, it could be whatever your currency is for a stock that's in whatever country. But let's use dollars just to keep it simple at this point. If you own 100 shares at $50 a share, you own $5,000 of stock. You now have a 2-for-1 split. How it works is you now have 200 shares, but your stock price has gone down the equal amount to offset that, or it's now worth $25 a share for that stock, or your same $5,000. So the key takeaway on this is when a stock split happens, I get more shares, but my actual value, I don't have actually more wealth or more money in that. Now I have more shares, and as share prices go up, well, then my wealth will go up or down, my wealth will go down. But I basically own more shares. Now, the cool thing about that, particularly if it's like a dividend-paying stock, if I have more shares, I get a dividends per share. So if they pay out $1 worth of dividends per share and I have 100 shares, well, I got $100 in dividends. But now I own $200, so now when I get paid, that dividend might be $200 as far as with the dividend. So that might be something that's very good, right? So depending on how they set up the dividend. So with a stock split, I get more shares, but I don't have more value in the total dollar amount. So why do companies do this? Why even bother with doing stock splits at all? I mean, for the company, it doesn't change their value or anything like that. It's the same. For the shareholder, it's the same. It's the exact same amount of money. Yeah, I got more shares, but it's the same amount of money. So why do companies do that? Well, so a lot of companies' value does not change. The price doesn't go down. Their price might be really actually rising. And for many companies, they're like, boy, if our price gets too high, that regular retail investor, that regular investor like you and I, they might have trouble coming up to buy a $300, piece of stock. They would rather buy maybe 10 of a $100 piece of stock, or 30 of some other, $5 stock, or whatever it might be. Stockholders, especially at the individual level, like just lower amounts, especially if it's like under $50 US, they tend to like that. So in order to kind of almost, not want to say manipulate, but in order to adjust that price down, what they'll do is they'll do a stock split. And as we saw, it went from $50 a share to $25 a share in our example. Well, that might be more palatable for people who are buying stock. Maybe the stock is at $200 a share. They do a 2-for-1 now. It's at $100. Well, that's maybe more easy for investors to get their heads around and be willing to buy it. So the whole idea is a lower price is more attractive and easier for small investors. The values are all actually the same. It's just easier for that smaller investor. And by making it easier for the smaller investor, their hope is that will then drive the stock price up. Because remember, the company valuation around stock price is important, and these managers and CEOs and folks, they own stock too. They get stock options, they get all sorts of things. They want to see the stock go up. They want to see their company be featured as far as a good stock company. So that's important to them, and it's important to their shareholders. So to serve their shareholders, they're like, we'll do a 2-for-1 split, we'll lower our price, we'll drive in hopefully more retail or smaller investors, and that'll then drive our price up because we got more people wanting to buy. It's that supply and demand, buying versus selling. So people are buying, it'll drive the stock price up. When you look at big institutional investors, big banks or big institutions that are managing portfolios, it means nothing to them to drop $300,000, a big mutual fund to buy $300,000 of a stock in one moment, basically, or in one day. That means nothing to them for these big institutional investors. So it doesn't matter to them if the stock is $400 or $500 versus $25. It's really more of a play for that smaller retail investor. And as a smaller retail investor, once again, you and I, we like stock splits because if it works out and the company stock then rises because of that and more people come in, we already own shares, great. That means we got more shares and the price increases, and that's a great thing for us. Especially as dividends and things might come along the way, owning more shares is always a good thing. Stock splits are great because we get more shares of stock, but another really, really great thing is stock buybacks or repurchases. If you hear a company you've invested in, you already own the stock, and they say, we're going to have a buyback of X millions of dollars, to a stock buyback or stock repurchase program, celebrate, yay, that means good things for your stock, and we're going to find out here in this lesson why this is great for you. So basically what a stock buyback or repurchase is the company is buying its own stock back, right? So they, years and years ago, maybe hundreds of years ago, they had initial public offering and they released all these shares of stock at an initial public offering price and people bought them. And once that initial public offering happened, well, then the stock is traded on exchange, and it could go up in value, it could go down in value. When a company buys its own shares back, it's basically buying shares off the market and then putting it into its own company, or they own the shares basically. It's part of the company valuation. So those shares aren't publicly traded anymore. So they're buying those shares back, which basically takes out shares out of the market, which is a good thing. Less shares in the overall market is good for you who own shares already. So why are companies doing this? Why bother buying their own stock back? Why don't they put money into equipment or hire more people or expand their operations or do a merger or an acquisition? I mean, they could do all these things, but one of their strategies might be buying their stock back. And a reason for doing that is they think their company is undervalued. Actually, they think it's really undervalued is what they're thinking. They're seeing their stock price. They know their price to book. They know what their future looks like. They're the insiders. They know all this stuff. And they're looking at it and they're like, what is going on in the market? Maybe the whole market is down, or what's going on with our stock? Why are we not getting the love we deserve as a stock? We're a great company. So we see this as companies really undervalued in terms of stock. So what a great buying opportunity. We know it's going to be good in the future, in the long term. So why don't we buy our own stock back at this low price, and then we'll be kind of recapturing those dollars. And maybe you may think the same way on a stock that's gone down. That's part of value investing, or buying some underperforming type stocks. So they're kind of doing the same thing. So when they do this, it's good for you. They're not necessarily buying your stock, but what happens, it's good for you because what happens in the market. First off, market is all about buying and selling, right? You can't buy a stock until you have a seller of the stock. And if there's more buyers than sellers, well, then that's going to drive the stock price up, right? That's that supply and demand. Now, when you have stock buybacks or purchases, you have a very established, well-funded buyer in the market being very active, and that's the company buying back its own stock. So think about that. You don't have to worry about all small investors and things, who's going to buy my stock. It's like the big companies out there, their own companies buying it anytime they can get, when they start seeing maybe fluctuations and buying, in their view, buying low. So you have an established buyer in the market who has publicly said, we're buying this stock. They publicly say this. They need to publicly say this, and then they, at a certain point, and they continue to buy the stock. It's also a signal to the market. The company has come out and said, we think our stock is undervalued. This is crazy. We're going to buy our own stock because we think buying our own stock is a better investment than investing in capital or people or expansion or any of that stuff. Our price is so low, we got to buy our own stock back and capture that low price. So it's a signal to the market like, hey, if the company thinks the stock's low, maybe there's something to this. Maybe the growth prospects are really great. And besides, it's going to drive the stock price up anyways, typically. So we might want to pile in now, along with the company, to buy that stock. So it helps drive the existing stockholders' price of their shares up. So stock buybacks are great because your value increases, right? You have more shares in comparison to others. There's less dilution is what that means by that. So you have more shares than you had before in comparison. You still have the same amount of shares. If I had 100 shares out of, let's say, 100,000 shares total, I still have that percentage. But if now instead of 100,000 shares, there's 50,000 shares total, and I have 100 of them, well, my value of my existing shares are less diluted. They're more valuable. Particularly when you look at things like dividends, if they're going to pay out a certain dollar amount of dividends, well, that dividends doesn't have to be shared amongst 100,000 shares in that example. Those dividends are now the same dollar amount or same currency amount now shared among the 50,000 people, and I have a bigger chunk of that 50,000 in comparison. So my dividends might be bigger along the way too. So there's lots of good stuff that can happen with stock buyback. So whenever a company announces a stock buyback, usually its stock that day will rise a little bit too. You can watch it. It may or may not, there might be other things in the market, but if you see that, that's a really good sign and a really good news for you that when a company is buying back or repurchasing its own stock. Maybe you're watching television or reading something on the internet or reading some publication, and all of a sudden something comes across that says, Company A is merging or acquiring Company B. And it's a big headline. It's a merger or acquisition, or M&A, mergers and acquisition. And that is a big thing in these companies when that happens. And it's a big thing for stockholders like us, whether you own individual stocks or own stocks in a mutual fund. Whenever there's an M&A or merger activity or acquisition activity coming on or happening, that can be very, very impactful, either good or bad, for our stock. So it's something we want to pay attention to for certainly the companies that we own. And in a nutshell, what it means is that one company is buying or merging with another company. An acquisition would be Company A is, we're just buying you. We're going to give you so much money or maybe so much in equivalent amounts of stock that we have to buy you. Either way, we're buying you. We're buying from your shareholders, basically. So we're buying you. That's an acquisition. A merger is still somewhat an acquisition. Somebody's usually a little bit bigger and other doing more of the buying, but basically it's a merging or two companies coming together. So it's less of one company just buying out another one. It's a little bit more of a coming together of equals typically. But they might be all called the same thing as M&A or mergers and acquisitions, but understand the dynamics from a leadership or management standpoint of how the company is going to be run in the future, right? I've seen companies that were pretty equal as far as size, but once they merged, the one company kept the name, they kept the leadership, the CEO stayed the same, and really the other company kind of was then wrapped into that larger, or not even necessarily larger, but wrapped into that organization. So a merger acquisition can happen with cash or stock or different ways to help finance that, debt even, to help finance this acquisition. And why do companies do this? Why do companies buy other companies or merge other companies? Well, one is to enter new markets. That's a real common way. That's a good reason for it too, is we're going to enter a new market. And by entering that new market, and try to, instead of putting a lot of money into our own research and development, try to start from maybe ground zero to grow to be an expert and then compete against this maybe leading company in a market. Why don't we just buy the leading company, wrap them into our organization, and then now we can be the leader in that market through our merger, through our acquisition. So it's one of the key things is they're looking to enter new markets. Think about when Google, for example, bought YouTube. YouTube is owned by Google, right? So, but they didn't always used to be. They were kind of a startup and then rose up there. So Google saw something, YouTube saw video and the potential for video and said, boy, this really matches up well with our existing platforms, our existing strategies. Instead of trying to create our own Google Tube or our own version of YouTube, which they have a lot of money, they could maybe have done it. It's like, why don't we buy the guys who really know what they're doing and let them do their deal or do their thing, right? So they bought YouTube. And actually today, that worked out real well. If you think about it, the number one search engine, if we just look at search, internet search or SEO searching, just looking at search, boy, I said search there like 5 times, didn't I? So for searching, Google is number one, right? It's even become the name. I'm going to Google it, right? For searching on the internet. Google's number one. You know what number 2 is, and you may or may not, but number 2, surprisingly, is not like Bing or somebody else. It is YouTube. More people search from first Google, then YouTube, just for general searching, and they're searching for videos is really what they're searching. But as far as actual searching, YouTube's number 2. And then there's Bing for Microsoft and Yahoo and all the others are so far behind, right? So, boy, what a great move for Google in this case, but sometimes companies buy other companies, it doesn't work out. But that's one of the ideas. You want to enter new markets, or you want to expand your reach. Maybe you're merging, maybe it's someone who's more of an equal and you want to expand your reach, not necessarily even into new markets. You want to penetrate your existing markets deeper. It's maybe the number 3 and number 4 guys getting together to help compete better against the number 1 and number 2 people or companies inside let's say a particular market. So trying to expand their reach into the markets they already have. A good example of that, the United States company, but there's others, they got some European operations, is Office Depot and Office Max. So you can tell by the name, they're related to office stuff, and really what they are is they're office supply stores. They're retail stores that sell things like paper and pens and folders and supplies you would need in an office. And that's what they do. They're big retailers that sell office supplies. They're direct competitors. They share almost a name, and they were, nose to throat as far as competitors, Office Depot and Office Max. So what they decided was, instead of competing with each other, let's get together and be a little bit better force in the market and compete against the third big competitor in the market, which was Staples, and we will compete better against that. Now even Staples looking to merge with the now new Office Depot and Office Max and trying to form all of them together, which can get into all sorts of monopoly or antitrust things. A little side bit on the retail thing, they're saying that online ordering of retail supplies and people like Amazon are actually now the big competitors for them, and they're struggling. So they're trying to expand their reach into the office supply market by merging with, together, maybe merging equals. Another way that the third reason why folks will really look a lot at mergers and acquisitions is that they feel they can run the acquired company better, right? They look at that competitor and they say, boy, that competitor's got a lot of good stuff going for them. Maybe they got a good lead in certain markets, or they're good in certain things, but overall, gosh, they run everything lousy. Their return on equity, ROA, or return on assets, all this stuff is bad, and they just don't know what they're doing, but they've got some success. That if we could just take that company over, we could get rid of the stuff that's not working, put more money and focus on the things that is working, and really do much, much better. And so that's, you might say, well, it's a little arrogant, but a lot of times, that's especially the leaders in an industry, that's what they look at when they look at the followers and say, instead of letting these guys maybe someday rise, we don't, and especially if they're poorly managed, you say, let's just buy them, add them to us, we'll expand our market reach, we'll expand being the leader, and that'll be a great thing. And we take out a competitor at the same time, and certainly can take an undervalued company and make it better, and now overall increase the value of the bigger company, which could be great for us as stockholders. So a good example of that would be like Wells Fargo and Wachovia. They're both banks, big banks, thousands and thousands of retail locations. And Wells Fargo, a very well-run, well-managed company, has been for years and years, hundreds of years, very strong company for a long period of time. And Wachovia, this is during, they acquired them in the 2008, actually early 2009, after the big banking crisis, when the bubble burst in the banks and the mortgage crisis, and all this stuff, when everything was bad in all these economies all over the world. Wachovia was struggling. They have all these locations. They were poorly run. They took a big bet on subprime mortgages or very risky mortgages that really hurt them. And they're struggling. Maybe they're looking at bankruptcy anyway, but they have these thousands of retail bank locations. So Wells Fargo looks at it and says, wow, we can get all these new locations, and maybe in some areas of the country where we're not in at all. If we buy Wachovia, they're running kind of not so good. Let's bring them in to the Wells Fargo way and take the good locations. We'll close the bad locations, or ones where we have duplication, where there's a Wachovia bank across the street from Wells Fargo bank. When we close the Wachovia, but now we can get into some new markets and we can run that acquired company better. And those are things you're looking at from an investor standpoint. When you see a merger and acquisition, step back and ask yourself, why are they doing this? Is it for entering new markets, expanding their reach? Can they run the company better? And then you can make decisions whether you want to stay invested in the company or buy into the company. A couple last thoughts here on mergers and acquisitions. Short term, the buying company share price usually stays the same or usually actually goes down. So like in that Wells Fargo Wachovia example, it's like, well, everything sounds great for Wells Fargo. In the long term, it turns out it will be, but actually the stock price will go down initially because they're outlaying the money. They're taking the risk. They're buying the company. And the acquired company shares go up because in order to sell the company, to liquidate the company and be merged or acquired by this other company, shareholders want something for that, right? They bought these shares with the idea that the stock will go up, and maybe it's been going down for a long time, but they still hope it'll go up. So they want to get a premium on their stock price. They don't want to be paid whatever the market's paying. Anybody can buy it at the market price. They want to get paid a premium for someone to buy all the shares. And so share prices can go up, sometimes up double digits in a day when you have an announcement of a merger and acquisition. So if you own the acquiring stock, that's usually a good thing. And if you're the acquirer, the person buying it, long term it might be a good thing, but short term you might see your stock go down a little bit. After it's approved and done, then the combined company basically becomes one stock. They might even change the ticker symbol of it, like Hewlett-Packard used to be whatever it was, like HEW or something, or HP, and now it's HPQ when they bought Compaq. And then it's been splitting off since then, and different things happen there, so that's not even accurate now. But the thing is, their ticker symbol may change a little bit, but you basically have combined the two companies together. And so one strategy from an investing standpoint, and there's actually a whole thing for folks who really just focus on this, who are very active, maybe more traders, is they're looking for companies that could be acquired. Remember the part where acquired company stock can go up, sometimes even dramatically in a day or two once they get acquired. So they actually look for underperforming companies and look for companies that are in industries where they might have others that want to acquire something about them. Maybe it's an underperforming medical device making company. That's a small guy who makes one device and it looks like a good promising device, but they're really struggling right now. And they hope a big company like a Medtronic or Boston Scientific or somebody like that buys them out and pays that premium for the shares. So they're investing in these underperforming companies that with the hope that they'll be acquired. Now the problem with that, if the fundamentals are still bad, the company's stock will still go down. And two things could happen. One, the stock might never go up, and they might not ever get acquired. The big company will invest in its own research and development and overtake them, and the company just goes out of business and you lost everything. Or you might have new competition coming in, because whenever there's a vacuum or somebody's underperforming, other competitors look at that and say, hey, if they're doing at least something, we could do it even better. Why don't we come in and invites new competition, which hurts you as well. So if the strategy is buy underperformers and hope they get acquired, if it works and it pays off, you're going to come out ahead. But that's a very risky strategy if that's all you're doing. But maybe you're looking at a company that says, yeah, I'm buying a value company. Maybe it's a little down right now. Maybe it'll grow up and grow its stock in the future. I have high hopes for it. The fundamentals may even look good. I might have confidence in the management. All these things that you're learning in the course. But there might be this little aspect too of like maybe they'll get acquired too. Maybe there's some rumors around that they might get acquired as well, and that might be an opportunity to get a little shot in the arm for that company, maybe a big shot in the arm if that company gets acquired. So mergers, acquisitions, hear about them in the news less frequently than they used to be, but they're still out there. And when you hear about mergers, acquisitions in a stock that either you own or you were thinking about buying, it's on your short list of stocks to buy, either it's the merger or the acquire or whatever it might be. Really looking to see what's going on because something big is happening when there's an M&A or merger and acquisition activity. Another type of activity that's very important to stockholders is when a spin-off occurs. So if we think back for a second, mergers and acquisitions, that means somebody's buying or merging with another company. A spin-off is the opposite of that. A spin-off was where you have a company, typically a larger company, and they're spinning off or selling off or creating a new division, or essentially not a new division, but a whole new company, right? And so it becomes two companies. In some cases, maybe even more than that, but usually it's two companies. So you have the one big company, and they spin off apart, and now you have maybe the big company is a little bit smaller, and you have the small other company, and you have two companies, two new companies. Though two companies, they're not necessarily new, there may be existing brands and all that, but they essentially trade differently on the stock exchange. The spin-off now becomes its own company, and you can buy shares in that spin-off, specifically just with the spin-off, without having to buy it part of the overall company. And that's the idea behind spin-offs, is looking at a couple things. And one is, if you spin off a company, you might have something that's really good, but you think it could run much better and be more focused as its own company. Think of like a big conglomerate that might have, like General Electric, that has, like, they're into banking, and they're into engines, and they're into software, and they're into consulting, and all that stuff, right? Well, maybe certain companies in there might be better if they split them off and let them run as their own company, and they were a completely separate company. So companies will split off apart if they want to have more focus, both in the parent company, the one who is the original company, and the child or the spun off company, to allow them more focus for both parent and child. Also, you can see better stock valuations, is the idea, is better stock valuations, because now that they're separated, investors can invest in either company more to what they're interested in, more to their liking. Sometimes when it's one big company, people are buying that stock because it's got this one little arm to it that they like, but there's also competitors out there that might do the thing the one little part does. And they would rather if the company split up, and then people will like the big company will buy, and then people like this new small arm that could grow, they can invest in that, especially if they're almost acting like two different type of companies anyway. So they're looking for better stock valuation for both the parent and the child, as opposed to one big entity. So an example of that, a really good example of that, is Altria, probably pronounced that wrong, but Altria was the parent company that owned a lot of different brands, and one of the brands it owned, two of the brands it owns was Philip Morris and Kraft Foods. So Philip Morris, you might have heard their name, they're famous for cigarettes. Philip Morris makes cigarettes. I think they're the leading supplier of cigarettes in the world. I believe they make Marlboro. I don't smoke, so I'm not the expert on cigarettes, but they make cigarettes, and they're the big player in cigarettes. Kraft Foods makes food, different types of foods, essentially particularly known for like cheeses and things that they sell in grocery stores, cheese and markets. So if you like your macaroni and cheese, you might like Kraft macaroni and cheese. If you like cigarettes, you might like Philip Morris, Marlboro cigarettes. The thing is, they're very different, right? If you think about it, if cigarettes versus food. If I want to invest in a cigarette company that might pay a high dividend, well, then I'll invest in a cigarette company. If I want to invest in a food company, I don't want to mess with cigarettes on it. I want to invest just in a food company. So when they're together, it makes it more troubling to invest in. And particularly, and this is a good example too, where the parent company and the founding of the company was on cigarettes, and is known for cigarettes. That's why they changed their name from Philip Morris, that owned Kraft, to Altria, to change that up a little bit. Because there's lots of people that say, I would love to own Kraft Foods. I think it's a good stock. I think it's a good market. The grocery, the consumables, the consumer package type goods, all those things. I think it's a good market. But I don't want to invest in a cigarette company. I hate cigarettes. I don't want to invest in a cigarette company. And cigarette companies have all these regulations and things I'm just not want to get involved in. I don't want to just invest in the food company. Why can't Philip Morris split off Kraft Foods so I could just invest in Kraft Foods? And that's really what happened. That's what drove it. Is there's so many shareholders saying you need to split these two companies up, because on their own they could be a great performing cigarette company or a great performing food company, but together they actually drag each other down. So they spun off Kraft, and now you can buy Kraft as its own stock, and the Philip Morris, or actually Altria, continues on, and you can buy a cigarette company through that. So are spin-offs good for investors? That's what we really care about. It's like, okay, I understand the business sense behind it. All right, now, is this good for us as investors? Well, the idea, and what studies show, is for both the parent and the child, it's good in the long run. In the long run, it's actually good for both companies to become more focused, and then people can invest in both of those. And but there is some short-term pressure on the spin-off. When investors get something spun off, they get shares in that new company, let's say Kraft, and they still have their shares in existing amount, as they split it up in Altria. And at that point, they might not want one of those. So if we spun off Kraft, and I really like Kraft, and I got some shares in Kraft, well, I might sell the rest of my Altria shares, my Philip Morris or my cigarette shares, and buy more Kraft or buy something else. So that can exert some downward pressure on either side as they get split up, depending on what people like, and as they move between the two or move completely out of the stock. So they can have some short-term, poor pressure on there. Long-term good, typically, but short-term pressure. Also, the person that's spun off, the company that's spun off, may not pay a dividend like the parent company did. The parent company might be really established, well-known, hundreds of years, who knows, and been paying a long-term dividend, but when they spin off the smaller company, that may or may not pay a dividend, which can then also exert short-term pressure, in this case on the spinoff. If I bought the big company because I like the dividend, now a portion of my shares is in the big company, but a portion now went to the small company, I'll sell that small company and buy the rest back into the big company so I can get back to my dividend. So that could be, that could be impactful too. And when they spin off too, they're not in an index a lot of times. Now Kraft might be because it's such a big company, from a big company, Altria, but a lot of times when you might be a big company in the index and the S&P 500 or a large company index, and when they spin off another part, well, that other part might not qualify to be in the index. So what happens to its shares? Its shares go down because people, companies that are investing, or mutual funds that is, or exchange trade funds that are buying an index, once that spinoff happens, they get rid of that. They get some shares of that spinoff, but are like, hey, you're not in the S&P 500 index. We're an S&P 500 index fund. We have to buy those stocks, so we're going to sell you, and we'll buy back into the big company. So you have some short-term pressure there too. But the long term, the studies show good. I mean, there's been lots of studies around spin-offs, and long term, it does allow for the management teams in these separate companies to really focus on their business and what they do best. They can get rewarded with like stock options and things to focus on that part of the business as opposed to being tied in with all sorts of other things. And you do also start getting new investor money in too. So we talked about the downward pressure which happens, but now you also get new investors that come in too. Altria, once again, is such a good example. Like, maybe somebody would say, I'd never buy Altria. I love Kraft, but I'm never going to buy anything because I hate cigarettes. Well, once they split off Kraft, they're like, wow, I can buy Kraft now by itself, and I think the long-term prospects is good for that. Well, here's my money. Here's some new investment coming in that will help drive Kraft, and same might help Philip Morris by being more focused too, or Altria. So as you can see, spin-offs are more than just a management type thing. They're all about management and how to be efficiently managing scarce resources, effectively managing separated companies. But as investors, when a spin-off happens, you really got to start making decisions on what you want to buy and sell. And do you want to have your shares split with that spin-off and keep those portions? Or do you want to buy or sell one or the other to, balance your portfolio or make different decisions? So when spin-offs happen, look closely at the information that they send you from the company. They'll talk about in the information how much of the existing company shares you'll keep, how many shares in the new company you get, in the value and the price for all that. And then from there, you need to make decisions as far as now they're two separate companies. So treat them as two separate companies and treat them as two separate investments in your overall portfolio. Sometimes what happens with some stocks you own because you're actually owning the company is the companies might have some good news, but then all of a sudden the stock price goes down, maybe even down quite a bit. It's like, well, how can a company have like maybe a good earnings announcement and some good things to report, and yet your stock price goes down? Why is that? And that happens sometimes. Well, sometimes it might be they're announcing some good news or announcing good earnings during just a period when the whole market is going down. There's something happening in the global economy or maybe in a local economy that's driving the whole market down lower. So even though they might have good news, they're going down as far as their stock price. Hopefully, they're not going down as fast as the rest of the market. So sometimes it can be a bigger global type thing or a more bigger as far as a market type thing. But sometimes the company has good news, everything looks good, and their stock still goes down, and it's not related to the market or anything else. It's really related to that specific company. And usually it's something that they've said in their earnings announcement or something that they've said with all this good news that might cause some nervousness or fear among investors as far as what the future looks like. Because remember, stocks are all about the future. You're buying a stock with the idea that the stock price will go up. You're investing in a company with the idea that the company is going to continue to grow and improve. And the way they grow and improve is by growing earnings and thus growing their value and growing their stock price. So sometimes when they say we have good earnings, we had good recent earnings, good past earnings over the last quarter, well, that's past news, but then they say something about the future, well, that can cause some consternation sometimes, or some fear or uncertainty or doubt among the stockholders that are out there. Let's take a look at a classic example. It happens to be with Facebook. Facebook's got lots of good classic examples in a lot of different ways. So here's a good classic example with Facebook to kind of understand why a stock might go down on good news, and you can kind of use this to help yourself to understand maybe some stocks that you're invested in, why that can happen, and what to do next about that. And as we look at this case study with Facebook, it's way in the past, but we can give us an idea of kind of what can happen as far as with earnings calls or with good news. Even it's going to sound like some great news with Facebook here, and yet their earnings went down. So back on October 30th of 2013, yeah, so a long time ago, you think about Facebook, and they're growing a growth company, and they easily beat their earning estimates, right? So far they're having an earnings call, and they're saying, hey, we crushed it. We beat our earnings estimates. Things look great. And they actually were able to show and demonstrate how they were beginning to profit from mobile search and people using mobile devices. And you think about that with Facebook, and you think about how now, years later, since 2013, how important mobile and mobile technology is. The fact that Facebook is starting to show earnings and beginning to profit from mobile back in 2013 in comparison to what ended up happening in the future, that sounds like great, like perfect. The stock should go up. And what happened? Well, the stock declined for 10 straight days. It's like, well, wait a minute, we beat our earnings, doing some good stuff and some new technologies and some new things that are advancing, particularly that is very, very important to Facebook, which is mobile and mobile search. How can the stock decline 10 straight days? What happened? And what happened was they had all this good news, all this great news, really, and if it was just that, it would be like their stock probably would have gone up, maybe even significantly. But Facebook also shared, in full disclosure, which is great that they did, but they shared that and admitted that younger users, especially teenagers, were not using the service as much as they used to. So think about this from an investor who's looking for long-term growth of a company, and Facebook has now come out and said to you, you know what? Teenagers, which are a very actually important part of Facebook, certainly Facebook's growth and beginnings from teenagers and college students is founded under the idea of social media and social sharing at Harvard. I mean, that core group, and they're now admitting that, like, hey, you know, those younger users, especially teens, they're not using us as much as they used to. And what do we know from social media sites? That, you know, a lot of those early adopters are young people, and now if they're moving off Facebook, well, what are they moving to? Are they moving to something else? Snapchat, Instagram, who knows what else? Google Plus, what are they moving towards? And could that be a real problem for Facebook if they're losing that teenage and that younger audience? And so people got scared about that. They're like, wow, that's great news for Facebook, but my gosh, if they can't grow their user base from the young people or whatever, then they're going to be like MySpace and go out of business maybe, or this is a catastrophe. And so people got scared, and the stock declined for 10 straight days. So they lost sight of the past news of, hey, earnings are good, and even some of the future news, which looked great, which is the profitability for mobile technology, and got all wrapped around a real core part of the business, which is good to get wrapped around, a core part of the business, which is younger users in Facebook and not using it. So that's what happened as far as for Facebook, and their stock declined, even though they had good earnings and this good mobile search thing. And that can happen into a lot of companies in a lot of different industries. Maybe it's a pharmaceutical company that has a great earnings announcement and everything's going good, but maybe a new drug that's in their pipeline fails some clinical trial. You want to see a pharmaceutical stock go down? Hear about things about failed clinical trials will drive a pharmaceutical stock down pretty quickly. Or something that's related to consumption or changing demographics or changing patterns of purchasing and buying behaviors of their main constituents or their core customers. Things along those lines, or new competitors or new things that are happening, new technology that might be assisting or not assisting, maybe causing some challenges within the marketplace. All these things are related to business, right? You're investing in a business. So the Facebook example was like, hey, we've got a core customer base that's not using us much. Think about that as any other business that has a core customer base that's not using them as much or buying as much from them, and you can see where the stock could go down. So the key part of all this is, so when you have good news and stock still goes down, try to figure out, and usually analysts, and there'll be papers and things written about what is happening, and figure out, well, why is the stock going down? And then you make a decision as far as do you want to continue to be invested in that stock, or do you want to be like the others maybe and get out quickly? It might be an opportunity to cut your losses, so to speak. If you're looking at Facebook, you might say, and maybe how it turned out is like, okay, we're losing our core customer, but there's still so much growth in different markets in the world, maybe growing with older people, maybe they'll be adding new features that may capture back some of those young people again. And by the way, that whole thing in mobile looks great, and the fact that they're earning money is terrific too, so maybe I stick it out. You know, that's one way to look at it, and you would have been rewarded for that. But another way would be like, hey, it's going down. I got to get off the ship before it totally sinks. So when you see these things happen, just analyze it, use your fundamentals and use what's going on, and think about, when I invest in this stock and the reasons I invest in this stock, is it still on that same trajectory? Is it still doing the things I want to do, or is something fundamentally changed with the company? Is the company moving in a completely different direction? And that might mean, hey, it's time to get out of this investment and into a new one. But certainly it's frustrating when there's lots of good news and you hear things like, you know, XYZ company beats its earnings estimate, and then it goes down, the stock price goes down 10%. Probably something that's hidden underneath that they shared with the world. In an area that's in any kind of investing that's really fascinating to me, whether it's in stocks or anything like bonds, cash, gold, whatever it might be, real estate, one thing that's very interesting is behavioral investing, or investing where you get a lot of emotion and things tied up into it, emotional investing or behavioral investing. Because if you think about investing, it should be this kind of quantitative, you're looking at numbers and you do things based on logic and all this stuff. And what really happens out there is things, there's some logic involved, hopefully a lot of logic involved, a lot of numerics and things that we're learning in the course that help us with that. But really, the underpinning of all this is that we are investing as human beings, and human beings have emotions, and human beings have behaviors, and some of these behaviors might not be the right behaviors. We might even accidentally or intentionally go against our best interest. The key thing with behavioral investing is understand that it's real, that's really out there, that we're not robots, that we are human beings that invest with a variety of reasons, and we have a variety of thoughts and feelings and, yes, emotions that can come into play. The big overarching things that really come into play as far as entire markets and things where entire markets might go up and down around behavior or emotion is really around fear and greed. This is what I've seen over the years. Fear, you see this a lot when the whole market goes down. There's some bad news, and maybe there's some legitimate bad news, like a financial crisis or a bubble bursting or something like that, like when the tech stock bubble burst, in the 2000, or when things burst as far as around home mortgages or derivatives or all these things. The markets go up and they go down. There's a natural cycle to that, but sometimes they go up too fast and they bubble and they break. It's usually greed that'll feed the bubble, and then when it breaks, it's fear that people are getting out, and it's can be a very traumatic thing. So when markets go down on bad news, or maybe a stock goes down, an individual stock goes down on bad news, it might be a little bit more of fear taking place as opposed to rational or logical thought. Now understand, your stock is still going down, but you can understand and think about it, is my stock going down because of something has changed with the organization or with the fundamentals or the market as a whole, or is it more of a short-term type thing? Same thing with greed on the other side of that, where we might hear of a hot tip, or we see an article, or we listen to maybe a financial expert, who's touting the latest great stock, which, by the way, everybody's hearing at the same time, so probably the price is inflated already. But we hear this and we say, wow, am I missing out? The market's going up and I haven't invested enough in the market. I need to get in there. And it might be some of that greed kind of coming in possibly, or just the fear of missing out on that. So understand whether it's fear when the market's going down, or maybe a possible little bit of missing out when the markets are rising, or maybe you've got a hot tip that may or may not turn out so hot. So understand that that is part of behavioral investing. You're making decisions based on behavior, and that might not be, well, that is not necessarily the right way to go. You want to use some of the tips and things in this course you're learning and through other things as you continue your education and learning to make good, logical, rational decisions versus emotional decisions. You're always better off with a logical or rational decision than, of course, an emotional decision. So what do you do? What do you do when everybody's panicking? Or what do you do when everybody's like jumping on board and saying stocks are going up, for example? Well, first off is to know yourself, right? Know your own pressure points. Know what your strengths are and your weaknesses are when it comes to investing. If you're a risk-averse investor and you don't like a lot of movement up and down the stock, well, understand that and maybe invest in stocks where they have less volatility. They're not a big up and down growth stock. Maybe they're a steady eddy dividend-paying stock, and invest in those kind of stocks. Or maybe you're somebody who likes to hold on to stocks thinking they'll always come back and you ride them all the way down. So if you've had that experience, think about, well, what are my pressure points? And maybe think, gosh, if I ever have a stock that goes down more than 15%, my thing is logically I'm just going to sell no matter what. And that might not be the right thing, but maybe it's better than writing down as it goes down 30, 40, 50% if you've had some bad experiences around that. But it all depends on you as the individual investor. So make sure you understand what your particular pressure points are. Also think about, how can I reduce those negative behaviors, things that might be impacting on a person on that. One thing I do, and I really believe it, is automatic investing or automatic systematic investing. If you're on the dollar, it'd be like dollar cost averaging, or things like in the United States where the 401ks, where you're regularly putting in money. Either way, it's automatic systematic investing. What we mean is it's automatically happening every month out of your checking account. It's automatically buying into a particular fund, or maybe you've put into a brokerage account or put into a mutual fund company, into a cash, a whole bunch of stuff. A good amount of money in cash, and every month it's continually buying some new funds or new stocks. Typically you have it where it's coming out of a paycheck, and you get that paycheck and you're either intentionally paying yourself first and putting that money into that account, that brokerage account or that mutual fund, or you're having it automatically done for you. If you have the ability through your employer, by the way, to have it be automatically done for you, that is the best way to go, because it takes out emotion out of it. It's just going to automatically be investing all the time. And sometimes you'll buy a little high as far as the market, and sometimes you'll buy when the market's a little low too, and that's good. Either way, you're automatically investing. You're not trying to time the market, which is always not a good thing. You're trying to just be in the market, continually buying and automating that. And I use that a lot, and it really, really has worked well for me over all these years. It takes out that whole emotion and that whole thought of like, am I buying low enough and am I selling high enough? You're buying it's buying part of it where it's automated, and then you can sell on a non-automated fashion. Also seek out trusted partnerships or partners. It might be your spouse, your husband, your wife. I've been very blessed with my wife that we are trusted partners and we work really well together, and we're really very honest and open with all our investments and other things that we do in our financial life as well as our non-financial life. If you have a partner like that, that's terrific, and really talk about things with that partner, and really be open with that person and say, like, I'm thinking about buying now, or I'm thinking about selling now. And they might be able to see, like, yeah, but are you doing this because of emotion or a behavioral issue, or are you doing this because this is the right thing? You should be able to use that as kind of a way of saying, if I can explain to my partner why we should do this decision, buy or sell a stock or mutual fund or exchange traded fund, whatever it is, if you can explain it to them and they can get agreement with you, well, then that's probably a better choice than just kind of going on your own. That's another reason why people like financial planners, right? A financial planner kind of will do more of that for you, whether it's an automated robot financial planner or an actual person who's actually planning your investments for you. So if you need some help that way, or want somebody to be more of a sounding board, well, that's where a financial planner can help do that and maybe give you some advice around that. It costs money to do that, of course, so you have to weigh the costs versus the benefits for you. But if you're somebody who really struggles with making decisions or emotionally wrapped up in decisions, then maybe a financial planner might be able to help you with that. Make sure you find a good one, a trusted one, and understand the costs behind that. There's also things out there you might find in your local town, investment clubs, where you get a group of investors together and they talk about investing, and they maybe have coffee or wine or whatever is the beverage of choice, and they talk about investing as kind of do-it-yourself investors, and doing it for fun and doing it for profit as well. And they'll share different ideas or tips or things that they're seeing happening, and maybe they see a certain stock or a fund that they think is good, and they'll share and talk about that as part of the club when you have a club meeting. So if you like that and you like that social aspect, You can join an investment club, a local one. There's probably some online Facebook groups and things too. Just be wary with those things that everybody's got their opinion. They might have some bad ideas too, or some emotions behind in the investment club that they're bringing to buy the hot stock or get out of a certain stock. So just take that into consideration as well. But it might be a good place where you can share ideas and just, sound off on things and say, hey, I'm really worried about this stock. This is what I'm seeing. What do you guys think? And you'll get some, third-party opinions. There'll be some independent opinions. So to wrap up this section, understand that behavioral investing is real. It's a fascinating area, and understand the idea behind, why you're making decisions, and is it based on logic or is it based on emotions? And so much of our investing and so much of where we hurt ourselves with investing is we get too wrapped up emotionally when we should be more focused on logical and rational and maybe automating some of these decisions.